Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, July 26, 2024. S&P 500 currently sitting at 54.52. I'm David Darling. I'm here with technical analysis torchbearer Ian McMillan. It's great to be back together with you. It's been a little bit, it feels like.
Been a long time, summer vacations and whatnot.
Yeah, you got to have them. Part of the way we recharge. But we've got plenty to cover. I mean, we could get on all sorts of soapboxes today based on the current events of our time over the past 10 days, 2 weeks.
Yeah.
We could also focus on price. We have choices.
And, markets have gotten a little weird. Now, I'm not saying anything out of the normal. I read we had our first 2% down day this week for the first time in almost a year.
Because I thought there was one earlier this year, but maybe not. I thought it was our second one, but I could be completely wrong about that. Maybe that was like a 5% pullback type deal. The several day scenario. So our first one in a while. These things tend to happen in an uptrend. Markets don't move in a straight line. I know investors would love the straight line.
Yeah, first 2% down day sent. I'm going to make sure I get this right. In March of last year.
Okay.
February of last year, excuse me.
So February of 2023 is the last time we saw something like that. And
not a bottom,
but pretty close to coming out of a bottom.
Yeah, we ended up buying like 2 weeks later.
Right. So price, but markets do what they do best. They fluctuate.
Russell fluctuating to the upside.
Yeah.
Or at least, it's holding in there a lot better than.
Well, it's gonna be closing 3 green weeks here, and we've had back-to-back red weeks of the S&P 500.
Yeah, about 40,000 as well. Mm-hmm. Pretty normal retest there. We got up to like 40, came back to, I'm going to call it 40,000.
And back in March, we had an episode called BTFD, Buy the Freaking Dip, and people still seem squirmy about any type of pullback, buying the dip. So I would say we don't have euphoria on our hands. Maybe there's optimism, but I would say there's plenty of skepticism.
Definitely plenty of skepticism. I would say this, as far as price structure, probably the weakest trend we've had since early April. That did end up breaking down. I mean, we went lower through for like 3 weeks, pretty normal 6%. I don't even know if we'll call it 6% correction. We've lost our rate of trend from the November lows.
You're connecting from November 23 and April of 24.
Yeah.
If you draw a line between those, we're below that rate of trend.
Yes, on SPX.
Yeah.
Obviously, NASDAQ is, from the November low.
It's holding it. It's holding the rate of trend.
Holding it. And also holding probably like a 100-day moving average.
100-day moving average. So here we have an 8% pullback in the Qs. We had just shy of 8% pullback of the Qs back in March. For the S&P, the pullback in March was approximately 5% and currently sitting with a pullback that's around 4%. And when we look at IWM, so small caps, I would say we have a little bit of a character change.
Yeah.
From the standpoint of it kind of hasn't flinched during this pullback it's really been a mega cap.
I've gotten crushed. So that relationship has really gotten hit. You've got NASDAQ versus Russell 2000. That relationship is below its 200-day moving average for the first time since March 2023. I think we just talked about March 2023. Still an upward slope. I mean, this really still an uptrend. We are, big turn. If you go NASDAQ versus Russell, we'll go out to a weekly. We're still okay.
Well, and if we're going to talk, if investors or advisors or market prognosticators are going to talk all smart about narrow breadth for 3 months, but not recognize that there was plenty of strength underneath the surface during this pullback. And so both sides of the quarter apply here, meaning like you don't get to say, oh, narrow breadth while mega caps are doing well, but when mega caps do poorly and the rest of the market holds up well, that's bad. Like it just is what it is. The rotation is the lifeblood of markets. There are times when small caps are leading. There's times where S&P is leading. And while it's nice to see the last, I'll call it 3 weeks for small caps versus S&P, there's still some work to do in that relationship. There's a falling 200-day moving average.
Yeah.
We're still below a rate of trend. Now we've reclaimed a prior low with a momentum divergence using RSI. If we clear the levels on a relative basis that we're at, you could really see small caps start to take off.
But
that's to be determined. So even with
or
this
does that
pullback,
happen in 2025? I mean, you've now had such a rubber band snap that, this relationship could essentially move sideways, do whatever I want for 3-4 months. And then we get into early November, obviously probably some memories of Keen there. Now I will say, and I think this is a really good point. Gosh, who brought it up on Twitter? One of the guys from Ned Davis, and I can't remember. But we had in 2016, Trump wins, we had the big initial pop, right? Small cap. But what outperformed over the next 4 years?
Right. The mega stock. The
mega cap.
And it's worth noting, and Ned Davis does good research. And so I fully respect, but during up to the election, and then initially the 3 months after the election, small caps had a pretty good run.
They did.
And then cooled off after that. So we'll see. It's not a guarantee of what's going to happen in the future, but they had about 20%, 18% outperformance versus the S&P during that February to January. So 11-month period could happen again. Is that forecasting a Donald Trump in November? I have no idea. Could.
We did fill the gap from
okay.
Well, for all those that love gap fills, and there's still more.
Are you talking S&P, Ian?
S&P, yeah.
Yeah, you're talking June 11th, June 12th. Wouldn't you know, price stopped right at the half gap. So we'll see. We'll see in the end, markets in uptrends still have volatility. There's plenty of instances of market pullbacks, and they're actually extremely healthy. The longer you go without having 2 to 7% moves, you increase the chances of the next move being larger. And so these pullbacks are good at resetting sentiment among those who are involved. As an example, the fact that we've pulled back, 4 or 5%, and you've got a VIX that reached all the way up to voting age, 18.
I mean, NASDAQ down 10 in 2 weeks at the low.
Right.
I think a little less, but we're going to call it 10.
Yeah, it's fair. It's fair to call it that. And meanwhile, when you look at some of these relationships, whether you're looking at Qs versus S&P or semiconductors versus S&P, yes, they have pulled back, but they're still within uptrends. Just the reality of the situation. Now, are these relationships that move sideways from this point forward that you gain no advantage by being tilted a certain direction? Very possible. And that's the beauty of technical analysis, is we can use these relative charts. Look at something like SMH representing semiconductors versus the S&P. We see the pullback that just so happened at a 1 point extension of the July 2000 and the December 08 low in that relationship. You extrapolate that out, we reverse directly at 1.618. Is there a cooling off in that relationship where semiconductors cool off this point forward? there's no way to guarantee that, but this would be a logical place where we see that. Don't know that you get short semiconductors, however. I mean, when you look at the leader of semiconductors, everybody's favorite NVIDIA, and you compare it to SMH, it has not flinched. It has moved sideways. So the leader continues to be the leader in semiconductors. And until that characteristic changes, then maybe we can get nervous about semiconductors as a whole. And I think it's important the practice and technical analysis of when you see weakness. Like you mentioned, Q is down 10%, Ian, in 2 weeks, 3 weeks. What are the things that were strong? What are the things?
Equal weight S&P.
Yeah. So equal weight S&P, fine. Industrials, you brought up Dow Jones, heavy with industrial.
I think financial, healthcare. I think of all the sectors, financial, of all the tech, let me rephrase that, of all the sectors, not called technology or communication services, financials held up the best, which basically means on a relative basis, they got their butt kicked the least. And they are, not surprisingly, given the, thrust and breadth and market participation, they are the first to back above a relative 200-day. They flat relative 200 days. So not saying like the all clear, but now financials are the only sector. Utilities are kind of close, but officially financials the only sector above a relative 200-day. Fascinating.
Well, when you look at the big dogs like JP Morgan going out to new highs, not down the last 3 weeks, when you look at Berkshire Hathaway on an absolute basis, and even more importantly, if you look at Berkshire Hathaway on a relative basis, that has built a range that goes back to 2008, right? A 16-year range that if we break out of that, you're telling me there's going to be problems with the U.S. market if Berkshire Hathaway is breaking out to new relative highs or continues in an uptrend. And that's that weight of evidence approach, right? If JP Morgan and Berkshire Hathaway were breaking down to the downside, you'd be like, yeah, maybe there's some issues here. Maybe we have some things we need to pay attention to. But you're telling me biotech stocks are up basically 3 weeks in a row while the broad market is down. That's not risk off. Financials being up, that's not risk off. It just so happens.
And one thing I find, I don't know what the word is, interesting about this resurgence in financial, Dave, is that, and I watched it happen over the course of, really the last 2 or 3 months, has built itself a pretty substantial weighting in that sector.
Yeah, and it happened before, really it happened on a broad-based sector basis. I completely agree. It is, and I should highlight.
I remember for sure as of the end of June, financials were the biggest sector. Technology was really the biggest sector for most of 2020, early 2024. And I want to say, really starting in April, May, it started buying more and more financial stocks, which, at the time, XLM, not the best relative chart. So you're watching it, you're kind of like, this is not what I would be doing, but what do you know it? Here we are. Even going up, but 2 weeks ago, it bought 2 more regional banks, and 3 weeks ago, it is really, and especially when you look at its benchmark, the S&P, it's a hefty overweight financial.
Yeah. And it kind of made that move before the broad sector did.
Absolutely.
And Ian's highlighting Adaptive Select ETF, which is a supporter of this podcast, which is listed on the NYSE under ticker ADPV, which helps investors access 2 of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. Since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. involves risk, including possible loss of principal by Quasar Distributors LLC. Thought it was appropriate to make that highlight, Ian, considering you noticed some of the changes that happened in the ETF the past few months. And it's just interesting to note a momentum strategy that's picking up, it casts the net out there and capturing the things that you just highlighted before we started to see this character change at a broad level. And so here we have a market environment with financials outperforming in the near term, biotech stocks outperforming in the near term, industrial stocks outperforming in the near term. That's not risk off behavior. We're not sitting here talking about staples. Now, staples might outperformed. And if that was happening in a silo, it was just that doing, you'd be like, okay, that's, something definitely take note of. But now we're seeing these other areas that are risk on doing just fine. I mean, we may look back a few months from now and this pullback that we're seeing along with the current events, right? There's a lot of uncertainty with the current events, right? You had a presidential candidate with an assassination attempt. You even had a media that tried to downplay it. You had a sitting president who did have
the guy. They just tossed the sitting president now in the middle of the night.
So that's a lot of uncertainty. I mean, I'm sure there's people listening to this that understand that that's kind of bananas, like literally banana republic type stuff, where you've got an assassination attempt. You've got a major hack that happens during the week with CrowdStrike. You've got a president who basically had the nomination ripped away from him by a certain party. That is uncertainty. And there would be another thesis. I know you highlighted this on X on Twitter as well, Ian, is that there's seasonality for a presidential election where you have an incumbent, and then there's seasonality for a presidential election where it's an open race. Can you talk about that a little bit, the differences between the two?
Yeah, I mean, if you take, and we say seasonality, they're averaging out every 4 years. You can slice it up as any way you want. But election year seasonality is pretty popular one. And then obviously that gets subdivided into, who's running for president? If they're an incumbent, is it totally open field, yada, yada. So historically, we go back all the 1950s, S&P every 4 years. You can call that a small sample size. It's probably 15 or 16 election years in there. N equals 16. People say that's small. I mean, it is what it is. I don't get to make election years every year. But typically, if you have a sitting president and incumbent who is running, which is what we had up until a week ago, markets do pretty well. They do better than your average election year. And that's what we had seen. Again, really heading into a week ago. Pretty above average, low volatility year. When you have an election cycle or an election year and it's an open field, so two brand new candidates, or at least two, not an incumbent. There's not a sitting president is not running. Obviously, I wouldn't call Trump a brand new candidate. He's a former president, but he is not the sitting president. So we're going to call this an open field for the sake of data.
Yeah, I think that's fair.
And those years, again, historically, look pretty especially when you get to June, July. June, July, August, September, and October, usually pretty weird, right? And we saw this in 2016. And then usually we rebound final couple months. It's people who invest based on things like politics and policy make their bet for the coming year.
So we could be seeing that second scenario. We're open to it, that the seasonality shift could be upon us, and that's what we're experiencing from a broad market perspective. The last 2 to 3 weeks is a shifting to that secondary seasonality that you're talking about. Time will tell. No way we know that going forward, but we also know that seasonality speaking, both of those scenarios have a mid-July through late August that are weak.
Yeah.
Perfectly normal. And then we'll see after that point. So a range-bound market at this point, especially considering, we talked about this past November through April, one of the most historic moves in a percentile rank for the market. And I think you could make that argument the same case through July, that the move through November 23 through July of this year is in top decile. And so to see a market now that's range bound through the next 45 days to, 3 months.
Yeah, or the 90 days.
Be perfectly normal. I'm not saying it's as fun. It's not as fun. Like, everybody loves a market that's going up. Markets that move sideways, boring, but it is what it is. It's a natural part. If we're going to digest this move in a healthy manner, I think sideways is better than straight down.
Agree. Totally agree.
What else? What else is worth highlighting? We've talked in financials, biotech, healthcare. I think it's worth noting housing, even using XHB.
Yes.
Didn't even flinch. That seems to continue to be intact. Industrials, we touched base on.
And that was a failure there in XHB.
Heavy.
They had really, July 1st fell out of its range, was below, granted an upward sloping, but below a 200-day relative moving average. And then what do you know that 10 days later, we're back to the races.
Yeah, and that's information because housing had been a leader off the bottom going back to late 02 or late 22. It had put in a higher low in October of 2022. It's been leading since that point. It's now breaking out of a massive range on a relative basis that goes all the way back to 2007. Doesn't that sound familiar? We were just talking about Berkshire Hathaway and its range. So is there a case for some area of the market to have value outperform? Because I think some would consider financials to be value and housing to be industrial and cyclical. There might be a case for that in the months to come. Because even materials holding up nicely, wrapping around prior highs on an absolute basis. This pullback may turn out to be a gift later on if people aren't willing to participate in it. They might be staring at that dip again. So the one they stared at in March, in April, and be caught when the tide goes out without their swim trunks on when we're higher again in fourth quarter. To be determined, but uptrend remains intact.
But that has been the MO.
It has
so
been.
far this year. And I guess we really only had one decent correction.
Well, and some of the other metrics, if we look at something like ICVT, which is a convertible bond fund that's a tilt towards companies that are tech in nature or high risk in nature or located in ARKK, those type of companies. And that's still holding up well versus the aggregate bond complex using AGG. So even the credit holding up okay. There's not necessarily any warning signs there when we look at the option adjusted spread for triple C credit. Near term uptrend, but long term downtrend. We're sitting right at a day moving average in those spreads. What happens here? Those aren't flashing warning signs. If anything, it's just been kind of this move in the VIX that we've seen the last 2 weeks. Time will tell if this turned out to be a viable bottom. What else? What else you want to highlight? It could be bonds, commodities. We haven't touched base on any commodities, crypto.
Microcaps also looking good. High beta versus low vol has fallen back to the bottom of its range. Of course, good move from all the equal weight stuff mentioned earlier. Equal weight, NASDAQ having a good last couple of weeks against NASDAQ. Well, again, these are still, a lot of these relationships are, they've made progress. They've dug themselves 5 foot out of a 25-foot hole. There's a lot to do. The trend is still that for a lot of these relationships, the trend is that NASDAQ tech, all that, still in the driver's seat. That's the way. The growth.
Yeah, I would say it.
Growth.
Yeah, it's still in the driver's seat. If you're going to see the relationship flip, this is how it would start. Like if you're going to start to see small caps outperform, this is how it would start. Doesn't guarantee that that's the case 6 months, 18 months from now, but the writing would be on the wall, the proverbial wall, if that is taking place, that just happened, that it just started. But only time will tell. Price can only confirm that thesis. The only way that thesis is confirmed is if we get and stay above a relative 200-day of IWM versus S&P, and even more so some important horizontal levels. And so it goes back to what you've talked about in the past. You got to prove it, small caps. Like you can't hold a job for 3 weeks and then convince me we've had a major character change here.
Honestly, you get promoted.
Yeah, let's hold a job for a year and then see what we do. Maybe, you being off your video games is great, but let's be steady Eddie here and put the work in. And that's what we'd like to see out of small caps. And I think it's interesting, the yen as well. This move we've seen in the Japanese yen versus the dollar, it tends to be coincident with, when you look at the bottom in that relationship of October 22, that's when a lot of stocks bottomed. November of 23, we saw the yen rise, and that's when we saw a massive breath thrust. Is this
you're right,
a bottom in July of 2024 that's a rotation into small caps? If that's the case, another thesis would be that it needs to clear and stay above 0.006 and move higher for what I would argue would be the continuation of value outpacing growth or small outpacing large. So time will tell. These relationships tend to take time. They typically don't V-bottom aggressively, take time to change. So it's not like anybody's getting left behind. There'll be opportunity for sure. Anything else you want to touch base on that our listeners might find useful?
No, I mean, Bitcoin, actually, we mentioned this to clients at the beginning of the month. Put out a note that it had fallen below its 200-day moving average, but to absolutely not be surprised if that ended up being a failure, given that it is still in a big uptrend. So it fell below its 200-day, fell out of its range below 58,000. And wouldn't you know, Dave, it was a failure. We are back in the range. We were back above a rising 200-day moving average and sitting at 67,000.
And I would say there's a fair amount of the crypto universe that looks very healthy, which would also be risk-on type behavior. So we've seen the market pull back here. What we're really talking about is we've seen large cap and tech pull back. Things remain healthy underneath the surface. I think you highlighted last week, or maybe it was the week before, that the bullish percent for whether you're looking at NYSE or you're looking at S&P or you're looking at the world has flipped back to X's. So offensive mode in the middle of the field, perfectly normal part of the game. Characteristics of this market remain positive. What would your opinion on that, or your thesis on that? What are some things that you'd be looking at, Ian, that would say, I don't think this market is as healthy as we thought it was?
I mean, I think back up above 5,500 would be the first short-term. That 5,500 on the S&P, we still got some waning momentum. Now, again, didn't last too long back in April, but I mean, it's going to have to get back above this horizontal level short term. Now, I mean, we're still in a very strong uptrend. There's other things where, to your point, we talked, they might have getting hard, but we came back, retested 237. Is this your best entry spot in May? I mean, I could argue that.
Yeah, for sure. I mean, it still remains an uptrend, and we know that to have these types of moves, and, we're heading into earnings season. There's going to be earnings volatility as well. But I think for me, if small caps are above 210, and if S&P 500 is still holding 5,200, and if the Qs are still above 445, and all of them continue to have a rising 200-day, it's an uptrend until proven otherwise. And
for an uptrend, Russell, has had an upward sloping 200-day. I'm going to say since February. I mean, it was a little wavy there for a couple years. So we've got that too. So pretty much you got Europe has outperformed over the last month. Not shabby.
You using IV or using VGK?
VGK.
Yeah, completely agree.
I'm not saying it's crushed the S&P, but it's outperformed.
For sure. So with that, I know we've covered a lot of basis, and there's things that sometimes we don't talk about, like we didn't spend an enormous amount of time talking about international stocks, but that should be information in itself. If you're listening to this, it's not because we don't like
China's
international
still
stocks.
pretty bad. China, no, bad.
When there's an uptrend on a relative basis of international versus S&P, you will hear it from us first, and we will be very excited about it.
I mean, China just hit all-time relative lows yesterday.
Yeah, just terrible.
I'm using GXC.
Right.
Terrible. China, since May 17th, it's down 13% in 2 months. I don't know what the S&P's done in 2 months, but I know it's not down 13%.
Mm-hmm.
Pretty right. And so then that's got ripple effects. It's going to weigh on emerging markets, which actually look pretty decent here. Once again, EEM bouncing off this 42 area. India helping a lot.
Yeah, India has been a positive attribution for international for sure. And EEM testing this range that you're talking about on a relative basis. Is it a tradable low versus S&P where it's holding a horizontal level? Could be. Time will tell. We'll only know. But until then, it continues to be a U.S.-centric equity market. Bonds continue to not be that risk parity trade. They're not offsetting that 40% of investors' portfolio. So if there's investors out there that are still riding a 60-40 portfolio, that should be a conversation that you're having with your advisor. So while we've had this pullback the last few weeks, that could continue because August is also historically weak for the market. Doesn't have to. We don't know that. But the characteristics of this market remain positive. We continue to see uptrends. We've pulled back into some of these rate changes, these upward rate of changes, and we'll see if they hold. If they don't, it doesn't mean immediate further downside. It just might mean that this market's moving sideways for the next few months and can chop people up in a 7% range. And that's when you have to remain disciplined and calm and not overtrade. But we'll see. Time will tell. Ian, I appreciate you being on here. Olympics start this week. Pretty excited about that.
Who are you rooting for?
USA, baby.
Yeah.
It's going to be good.
Did we get any new sports this year?
Ooh, I'm terrible at that. I'm terrible at paying attention to.
Yes. 4 new sport.
Okay, what do we got?
Skateboarding.
Really?
Sport climbing, surfing.
Cool.
And breaking. I don't know what breaking is.
So what was the second one? You said skateboarding, something, surfing, and breaking.
Sport climbing.
So
like
rock climbing, wall climbing?
That's what I'm wondering. Breaking is
it breakdancing? No way. It can't be. What is it?
Oh,
We throwing the cardboard down?
it is dance. Oh my God. It is breakdancing.
That's great. Yeah, like they're throwing the tarps down and they're breakdancing. I don't know how that got in there, but it did. I wouldn't do great at it. So I guess why not? Why not it be a sport? What did they get rid of to add it? I hope it wasn't something good. I think they did that to fire the people out.
Well, they got rid of baseball and softball so that we could watch people dance.
Well,
maybe we should just end the episode right here, Dave.
TikTok.
Before I say something that's going to get us canceled.
We could do that. We could absolutely end it. I appreciate you being
God's on my shoulder saying, dude, just end the episode.
Okay, we got it. We're out of here. We appreciate everybody listening. Give us a high ranking, share with your friends. That helps us out, and we really appreciate it. Thanks for being on here, Ian.
Thank you so much. Have a great weekend, everyone.